So good morning, everybody. Welcome another STC webinar. My name is Pim van Baarsen and I'm CEO for the Silverstone Technology Cluster. As you're aware, this is part of a whole series of informative and valuable webinars that we're doing. So today, I'm going to hand over to Duncan Mitchell very quickly. We're going to be talking about tax, and I always know how I feel when we're talking about tax. But in this particular occasion, we're also going to benefit from it. So this is going to be a very worthwhile session to get stuck into. So welcome. Duncan is going to start his presentation in a moment, and I normally do sort of a little bit of housekeeping. So Duncan is actually quite happy that if any questions come up, he's quite happy for you to sort of raise them as they come up. You don't necessarily need to wait until the end. Of course, you're free to do that, but if you wanted to get sort of stuck in the middle of the presentation, then please feel free to do that. So there should be a raise your hand functionality within Zoom. So either use the functionality to do that, or indeed switch on your camera and give us like an actual wave, or attract my attention, and then obviously we'll hand over to you to do your question. But by all means, we're going to have a Q&A session at the end of it as well. So then feel free to engage with that as well. So I'm gonna leave it there. So I shall hand over to Duncan now, and yeah, Duncan, take it away. Tell us how we can save some money.
Thank you. Right, thank you, Pim. Yeah, so first of all, I'm Duncan Mitchell, and our business is CED Accountancy Services, and we're based just down the road in Toaster. And so we're a firm of chartered accountants, and we have three partners, myself, Peter Aratoon, who's also a member of the Silverstone Technology Cluster, and Cliff Davison, who's fairly well known in these parts. And our businesses and clients are mainly small owner-managed businesses, and we also have a number of personal tax clients where we prepare tax returns and advise on inheritance tax, personal tax, capital gains tax. And I must admit, for the last 17 or 18 months, we seem to have taken on more and more knowledge, more and more responsibilities, and I don't think we've ever been so busy. And a lot of the new legislation has come about as a result of the COVID-19 pandemic, and so we found we've got to learn lots and lots of new stuff. So the webinar today is about enhanced capital allowances, and that's really directly as a result of the government trying to make sure that as we come out of the pandemic, as we steadily are and surely are now, the economy kickstarts itself, which it appears to be doing anyway. And will even more so once these new tax rules and begin to bite. So let me just explain. This webinar is about the 130% super-deduction, and just quickly before I move on, if you listen to this and act on it without taking the appropriate advice, then of course please don't come back to me and say that I didn't tell you not to do it or told you to do it, because obviously before you do anything particularly based on this is large-scale investment in your businesses. You need to make sure you take the proper tax and accounting advice, because it's not something that's easy. There are a lot of pitfalls, and HMRC always put in anti-avoidance legislation to stop people trying to take advantage of the rules, either wittingly or unwittingly. So please, if you're thinking about doing anything about anything that I suggest, please contact your accountant or contact me if necessary. Okay, so as I said, the changes in the capital allowances were made in the last budget. The Chancellor announced them, and they were a welcome surprise. Certainly on the face of it, they would appear to be very generous to businesses, and essentially for those businesses that are going to invest in new fixed assets being anything which is not a cost which goes to your profit and loss account, essentially it's going to be a cost that goes to your balance sheet, then most of the assets, the main pool items that your business buys, will be eligible for 130% on the cost of that item, tax relief on 130% of the cost, as opposed to, at the moment, 100%, which is the annual investment allowance for new plant and machinery. So therefore, to put that simply, if you buy an item of plant for your business which costs £40,000, instead of getting £40,000 deducted from your taxable profits, your company can benefit from £52,000 deducted from your taxable profits. This is applying 130% uplift to the £40,000 worth of cost. And there are certain assets as well that generally are embedded within a property, which only qualify at the moment for 6% writing down allowance. And within these new rules, there's also a chance to get 50% tax relief for what's known as integral features. And that is also quite a nice benefit for businesses. Now, as I said, the main reason I think for these enhanced deductions for capital allowances is to kick-start the economy. But obviously, given the generosity and given the fact that the Chancellor will need to claw back some tax at some stage, the opening is time barred to the 31st of March 2023. So therefore, businesses will need to review their fixed asset budgets and expenditure budgets for the next couple of years and just see if there's anything that's going to be purchased beyond 2023, which might benefit the business by accelerating that purchase before the 31st of March 2023. So there's time barred. Now, at the moment, there is a relief for all businesses that if you buy fixed assets for your business, you get 100% tax relief, and that is capped at £1 million. And at the moment, that is time barred to the 31st of December 2021. Now, an important point about the 130% deduction is there's no upper limit on the amount that you can invest in your business. So it's unlike the annual investment allowance, which is capped at £1 million. There is no upper limit. So you can be looking at more. So there's few businesses that really would be looking at expenditure into medium-sized and large companies that will exceed £1 million of annual investment allowance in any 1 year. But just to be aware that if there are businesses that are looking for capital expenditure, it's not capped at £1 million. Importantly, the 130% deduction is only eligible for companies. So if you're a sole trader or a partnership, this 130% tax relief isn't going to apply. Now, if you are a partnership or a sole trader, it might be time to think about whether that vehicle for trading would be better served by incorporating your business and making it into a company, particularly if you've got large-scale fixed asset expenditure on the horizon. And anyway, if you're making some pretty good profits, there are tax advantages and credibility advantages in incorporating a business and calling it a limited company, as I'm no doubt most people are probably aware. Further points on the expenditure: it has to be expenditure which is on new and unused equipment. So second-hand equipment is not going to qualify for the 130% tax deduction. You're looking at other rates for second-hand equipment. No cars qualify for this 130% deduction. And also, many companies, we were talking about a major item of plant just before the webinar started with one of our delegates, Ian, whose screensaver is a typical item of plant that might come into this restricted a restriction on whether you can claim 130% tax relief, because many companies, particularly construction sector, will form companies to trade from and then they will have their plant, major items of plant, separate in a different company, just so that that plant is protected if anything happens to the trading company. And the plant company, which holds the plant machinery, would then lease back its plant to the construction trading company, which it would use in its trade. Now that would be one of the restrictions whereby you would not be able to claim the 130%, because lease plant is accepted from the 130%. Now you can finance your new and unused equipment, and hire purchase is perfectly acceptable. Now hire purchase can be a 3-year or a 5-year or 2-year term, and you effectively, for tax purposes, the point of acquiring the asset is the point at which you get the 130% of the tax relief. So if you've got a 5-year hire purchase agreement for an item of plant, which starts in September next month, then your tax point for that 5-year hire purchase deal is actually September. So you'd be getting your full tax relief, or 130% of the cost of that item, in September, being part of whatever year end you have. Some further practical aspects are that you can interact your different types of capital allowances. So plant and equipment at the moment will qualify for 130% tax relief, but there might be an argument that you would not want to use the 130% tax relief, because the clawback, in certain circumstances, if you were then to sell that asset, would make it potentially not so attractive. And also, as I mentioned earlier, the 50% integral appliances, which generally are embedded in a property on which you can claim 6% tax relief, would also qualify for the annual investment allowance, which is £1 million. So if you're buying integral assets for a property, instead of getting 6%, you can claim annual investment allowance at the moment of £1 million. So integral assets, the order would normally be you would claim £1 million of you would claim any unused annual investment allowance up to £1 million, and then you would start to use up your 6% rate. But at the moment, up until 31st of March 2023, instead of going from the annual investment allowance, the AIA, to the 6% allowance, for a limited time period, you can go from the AIA to the 50% special rate allowance. Now, there is a date from which, if you've entered into a contract before this date, but your expenditure actually starts from the 1st of April onwards. Now, bear in mind that the window for 130% tax rate is from the 1st of April 2021 to the 31st of March 2023. But any contracts entered into before the 3rd of March 2021 would not qualify for 130%. It's for contracts from the 3rd of March 2021 onwards. And as I said earlier, there are some quite complicated rules on what happens if assets that you've purchased and claim the 130% tax relief on purchase are then disposed of, and the rules change whether disposal is made before the 31st of March 2023, which is when the window closes, or after that point. And there's some complicated, as I said, complicated computations and some complicated forecasting really to do around your capital allowances expenditure, and when replacements are going to need to be made, or when you're going to sell those assets. And it is highly worthwhile talking to somebody who knows about this to make sure that you maximize the tax relief, because what you don't want to do is get the 130% tax relief up front, but then find that a lot of that tax relief is clawed back because you haven't quite timed the disposal correctly. So as well as timing the addition, it's quite important to time the disposal of an asset. And as I mentioned on point 5, clawbacks are key to planning around this tax relief. Now, I said earlier, no cars qualify for 130% tax relief, but many of my clients are going electric. In fact, I think all cars are, all new cars but please, if anybody considers this to be incorrect, but I think from 2030, all new cars certainly will need to be will be electric, certainly in the UK. Now, at the moment, electric cars purchased for a company or a sole tradership or a partnership are highly tax efficient, because you get the whole amount of the cost of the car, electric car. This assumes that the CO2 emissions are zero. The rules on hybrids are slightly less attractive, but essentially you get the whole cost of an electric car set against your profit. So I have at the moment clients who are aware of this now, who are buying Teslas, Porsches. The Porsche Taycan is an electric car, which is very attractive to some of my clients. Certainly when I say to them, well, why don't you buy an electric car? They've never actually thought about or even remotely considered that they could justify a Porsche, but actually the tax relief around an electric Porsche is actually quite nice, and can go in some way to justifying such an expensive acquisition. But not all my clients who are buying electric cars are buying Porsches. Teslas are an attractive manufacturer at the moment, as is Peugeot. There's a nice Peugeot 208, which is electric, which is a slightly more on the more affordable side. But electric cars are highly tax efficient from the corporation tax side, and also from the benefit in kind side of things, because they become benefit in kind vehicles for a director or an employee of the business, and the rates of benefit in kind are extremely low at the moment. But that may change. As I said earlier, we will be entering a period of when the government are going to have to start clawing back some tax, and it'd be quite interesting to see how the Prime Minister, it seems to be enjoys spending money, offsets or comes to an agreement with his Chancellor, who I think will want to claw back tax and reduce expenditure. So I think we're in for an interesting ride on that side of things for the next couple of years. But the key will be ensuring that we navigate the rules that the Chancellor puts in place as best we can. And at the moment, this is something that's there, a nice surprise for businesses, and we must make sure we make the most of it. As I said, the clawback. Now, the clawback works differently depending on whether an asset is sold before the end of the window, which is the 31st of March 2023, or whether the asset is sold afterwards. Now, if you imagine the scenario whereby you buy an asset for £100,000 and you claim 130% tax relief on that, you have claimed 130% of the cost of the asset. But if you then sell that for £60,000, normally with assets, you would then be taxed on £60,000. But because there's a bit of a sting in the tail here, but because you've claimed 130% on the original acquisition, if you sell before the window closes, you actually have to uplift the £60,000 sales value by 130%. So actually your deemed disposal in that scenario becomes £78,000. So therefore, the planning point might well be that if you're going to sell your asset, you will perhaps defer the sale beyond the 31st of March 2023 to reduce your balancing charge. But then another sting in the tail occurs, that the corporation tax rates are due to go up from the 1st of April 2023. So in the scenario where you're selling an asset for £60,000 you don't have an uplift on the sales value of 130% times £60,000, the sales value is still deemed to be £60,000, but the corporation tax rate that you're paying on that £60,000 could be as much as 25%, because the corporation tax rate for companies could be 25%. There's a sort of a sliding scale of corporation tax rates for small companies, increasing to larger companies. So the timing of your disposals and your timing of your additions and your consideration of what tax rates are going to be in force is absolutely key in all your calculations that you're doing. And I don't want to make this too technical, so I'm beginning to draw to a close on this. But another welcome surprise that occurred in the budget from the Chancellor was the chance for businesses to carry back their losses, and this applies to both companies and sole traders and partnerships, whereby if you make a loss and the Chancellor is thinking, right, okay, some of your companies, some of the businesses have really been impacted quite badly by the pandemic. So therefore, if your business has made a loss for any year ends ending between the 1st of April 2020 and 31st of March 2022, which is not beyond the realms of possibility for many businesses, certainly in my experience, this has cropped up. Now, under normal circumstances, that loss would be carried back 1 year maximum, whether you're a company or a sole trader or a partnership. So therefore, if you made a loss in that period between the 1st of April 2020 and the 31st of March 2022, but you made a profit the previous year, but not much of a profit, then you wouldn't be able to relieve much of your loss to get a corporation tax refund. So the Chancellor is saying, well, actually that loss, instead of just carrying it back 1 year, what we're going to allow you to do is we're going to allow you to carry it back 3 years. So instead of having 1 year of loss relief, potentially you're having 3 years of loss relief, which might result in 3 years of corporation tax payments that the company has made, or 3 years of income tax and class 4 national insurance for sole traders and partnerships, repayable to the company or to the individual. So that's quite a nice sort of relief for businesses that have made losses. Now this opens up, however, some planning points for businesses that may be thinking of capital allowances. But what you can do is if you enhance your loss by investing in new plant and equipment and new fixed assets, or even move a profit into a loss by investing in capital allowances, then potentially you're getting 130% cost enhanced relief on the cost of that asset, which deducts from your profit to create a loss, or potentially enhances a loss, which can then be carried back. So there's a planning opportunity to increase a loss, thereby getting a higher corporation tax or income tax refund. So there's some planning points there. And what happens with the relief is you relieve the most recent year first. So for a loss that occurred, say on the 30th of September 2020, you would look to relieve 30th of September 2019 first, and then go back to the 30th of September 2018, and then 30th of September 2017. And that's how it works. I've whizzed through that, and I had expected to be interrupted, but I don't think anybody has interrupted me, which is fantastic. Which is normally when I talk about anything, people tend to interrupt me. So that's a first for me. But I hope I'm going to hand over to Pim Pim in a second, but I hope everybody found that reasonably instructive and informative. And thank you for listening to me. And Pim will also pass on any contact details if you would like to contact me. As I said, I'm in Toaster contact, or most of the normal methods. Thank you.
Thank you very much, Duncan. Really, really interesting. If you'll allow me, can I ask just a couple of sort of rookie/dumb questions? So if I had a company, because obviously if you're going to buy like proper machinery, like CMMs or like proper machines, then obviously that qualifies. But if for instance you have a design office and you wanted to upgrade everybody's computer, would that qualify as well?
Yeah, absolutely. Certainly for a company. Now it depends on the size of the company, because many companies would have a threshold under which certain types of expenditure, even if they are sort of fixed assets in nature, such as computer hardware, new PCs, almost a server. So if you were to buy a new PC for £1,000, depending on the size of your company, if you're a large company, £1,000 wouldn't really qualify as a fixed asset addition, because it would be potentially be deemed to be too small. So it would therefore be expensed through the profit and loss account. So the company in that scenario would have to either reconsider its policy on capitalising its expenditure, and say, well, actually in this scenario we are going to capitalise this expenditure, because it is, even though it's a small item for a large company, £1,000, it is actually a fixed asset because it's not a consumable item. It will stay within the business for a couple of years. So, but yeah, re-equipping an office with computers would qualify for the main rate plant and equipment, which means it would qualify for the 130% deduction, provided it's a company.
And by the sounds of it, it could potentially apply to laptops as well then.
Absolutely, yes, provided you capitalise the expenditure. That's the main point I'm making. It's not all businesses would capitalise that expenditure.
And if I wanted to, obviously this is all hypothetically speaking because we're not doing any of this stuff, but if I wanted to, I don't know, upgrade my offices or maybe even like build an extension to it or anything along those lines, would that be part of it as well potentially or not?
Yeah, potentially. Yeah, potentially.
But that's slightly more murky, so we probably need to talk to the likes of you or existing accountants to get a more of a feel of what that means.
Absolutely, yes. I mean, once you start building structures, it becomes a little bit more complicated, because not all the items in a structure will qualify for capital allowances. So, for instance, the bricks and mortar or the wood or whatever the material is you're making the extension or building the structure don't generally qualify for capital allowances. But within a structure, you've got water systems and electrical systems and air conditioning systems and potentially other items such as, and now you're pushing the borders, insulation and specialist floors and all that sort of thing. And then that's where you need the expert to come in and say, well, actually, this does qualify or this doesn't qualify. And then once you've established whether they qualify, then you start to look at into what pool they go as to what rates of capital allowances you get, because ordinarily some of those items would just qualify for a 6% write down, which is not really here nor there. But under the current rules, you could be looking at 100% or 50%, and there's all sorts of sort of choices now. The accountant that's on the ball will be saying, well, this is what we need to do with this expenditure, and this is what we need to do with that expenditure. So it's quite a complicated area now, and it gets more and more complicated as the government try to simplify things. They actually make things more complicated. There isn't actually an office for the tax simplification, but since that office came into being, it's actually got more complicated for tax law.
But it does sound like that if you're considering upgrading stuff, then the next 2 years is a good time to do it, because there could potentially be benefits there. So get somebody.
I would say the headline would be make your capital expenditure before the 31st of March 2023. But there are a few provisos which I've mentioned.
Yeah. Don't spend willy-nilly. Talk to somebody who knows what they're talking about first. Sure.
Absolutely. Yeah. Absolutely. Yeah.
Ian's raised his hand, so we'll hand over to Ian. Now, go ahead.
Thanks. Some of our customers are investing money based on other government grants available to them, where they got projects or otherwise, and they've approached the government for investment, or I don't kind of know what these programs are that they're being offered. Basically, there's a number of projects that are coming off at the moment with our customers where they've gone to the government for assistance. Now, because they're assets and they're coming into the business, can they still claim this 130%, or because it's part of the government, because it's part of another government grant, does that exclude it from it?
Well, it's a good question. Ian, what sort of items are they? What sort of assets are these customers purchasing?
Compressed air equipment. So this is compressors going into a plant services. Some customers looking to do a complete installation.
Yeah. Okay. Well, the government grants are taxable. That's the main point to take. So
Okay.
and essentially, with government grants, particularly if you're financing or that money is going towards fixed assets expenditure, there's two sort of alternatives on the way that the grant would be shown in the accounts. Now, the grant is either shown against the cost of the asset, in which case I will double check this. I'm not entirely 100% sure, but I think you would then claim capital allowances on the net cost of the asset, being, the cost of the compressor less the amount that the government has contributed. So you're only getting tax relief on the net cost. Or alternatively, the other way that government grants are shown in a set of accounts is they are released to the profit and loss account over the term of the fixed asset. So if the asset is deemed to be have a 5-year life, you would have the full cost of the asset in the accounts, and that asset is written off over 5 years. In which case, I think that you would be able to claim 130% tax relief. But in your profit and loss account, you'd release that grant, and it would be taxable over the 5 years of the plant and equipment. But I can double check that. But I think that's what you'd probably do. I mean, government grants at the moment are everywhere. Obviously, we've had 18 months of all sorts of government grants, and HMRC are increasing their compliance work on these grants. So it's important they get treated properly, both for tax purposes and accounting purposes. So I'm happy to look into that further, just to give you a definitive answer. Pardon?
Can I throw an example then? Can I throw an example just so I understand your point? Say if a compressor costs, or a piece of capital equipment costs £10,000, the government's got a 50% grant, therefore you pay £5,000.
Yeah.
Because you've invested £5,000, you can claim 130% on that £5,000 based upon it being the net cost of the asset. If it's spread over a period of time, if it's released over a period of time, then you will only be able to claim 130% on whatever you are spending, or whatever you are spending on your capital for that given year, up to the 31st of March 23.
Well, you've got an interesting scenario, because what the taxpayer's interest would be to spread the grant of £5,000 in the profit and loss account over 5 years. Say that the life of the asset is £5,000, and that would be taxed to corporation tax in it for each of the accounting years. Now, as I said, if you did that, what we'd need to do is look at the terms of the grant to decide the correct accounting treatment. But the scenario you describe is it would be beneficial for the taxpayer to claim 130% on £10,000 and then spread the grant in the profit and loss account, rather than 130% of £5,000. But as I say, that description and conclusion I've just come to, I would need to double check on that just to be sure. But I think it depends on the terms of the government grants as to how you account for them. But there is scope there but there is scope there, as I said, to get a more favourable tax outcome. But we'd need to be careful to make sure we're right. That's all I'm saying on that, because there are a couple of options as far as I can see that we'd need to be doubly sure on.
Yeah, we're not advising our customers. We're not advising our customers on how they have to go about spending or gaining grants or otherwise. But it's just knowing the right information so we can feed to them, and then they can feed back to their accountants or otherwise. So that's good feedback. Thank you.
No problem.
Excellent. Very, very interesting. I mean, Richard, I saw you put a thumbs up there. I don't know whether you just like what you were hearing, or whether you want to come in and make a point or not.
Probably both, actually, but I'll come online. Just thank you, Duncan. That's been interesting. I want to go down the route of we're in an area where we can spend quite a bit of capital money on software tools, and I assume there isn't any problem with investment into software that would be affected by this. What is that?
Software is an intangible asset. It's not a physical asset. Again, I will come back. I'd have to come back to you on that, just to be 100% sure, because I'm not entirely sure on that question. But I think your software can qualify under the capital allowances regime for normal fixed asset expenditure. But I think there's a couple of options on how you go about sort of almost an intangible type of expenditure. You're into something a little bit more complicated, because there are options on that which would need to be explored. So it's a little bit more of a out there question than buying a compressor, for instance. Do you see what I mean? But again, I would love to come back to you on that and just explain exactly what those options were for software. What type of software would it be?
These are typical design tools, CAD, PCB and mechanical CAD tools. So they can quickly get into £5,000 to £10,000, £15,000 per seat. Also, they are increasingly offering different ways to price that, and sometimes that can get into what gets close to being a leasing. You're basically paying for a 12 months usage of it. And even if you pay an upfront £10,000, then you're often looking at £2,000 or £3,000 a year for maintenance costs on it, which I would imagine are. Is there any option for getting those included into this?
Well, with leasing assets, again, you've got to be quite careful with leasing assets as to whether the treatment is of those payments, whether that's just a profit and loss account item, where so you're effectively hiring something, which means that your payments are going to your profit and loss account as opposed to them being an asset. Now, particularly with cars, the unwitting can be sold something like a PCP, a personal contract, thinking that they're actually buying the car as a fixed asset. Now, but when you actually look at the detail of it, it's more in line with a hire of an asset, and so the accounting, the tax treatment doesn't necessarily reflect what was it originally intended. So again, that would be the case with your financing on the software. I think it would need to be looked at in each scenario in the terms of the leasing deal to check whether this is actually a fixed asset or whether it's a higher deal. Do you see what I mean? So it's as I said on the outset, it is essentially the headline is quite nice, 130% tax deduction for assets, but you do need to take care on how you go about doing it to make sure it's correct. So you're into software which has got its own sort of rules anyway, and then if you add into the mix a financing deal for that software, and it would be something that you'd need to be careful of rather than just go into it, I would say. I hope that answers your question. I know that's not probably a definitive answer, but that all I would say is in that scenario, just take some care with your advisors on that one.
Yeah. Okay. Brilliant.
Thank you. No, thank you.
I mean, it sounds like potentially there's good opportunities to be had. So it definitely feels like it's worthwhile talking to,
pursuing it. Yeah.
Yeah, and
Absolutely.
getting to talk to knowledgeable sources and seeing what we could do there. I also quite like the prospect of us all driving Porsches soon. So that should be something that we should all look at, shouldn't it?
Yeah.
Sounds of it.
There is a Toyota Aygo as well.
Cool. Okay, that works. I also know there's a cute little electric Honda out there, which is quite nice. So that might be an option as well. I'm just wondering and conscious, is there anybody else who has any queries or any questions that they want to raise? I'm obviously very conscious that while we have an expert in the room, why not fire any questions at them? So does anybody else want to raise their hand, or by all means put the question in the chat if you're a bit shy and want to do it that way? That's totally fine. Is there anybody else who has any stuff? I mean, while people are pondering, Duncan, just in terms of the background for it, why are the government doing this? Is this just kind of like an incentive to get companies to buy more stuff and therefore boost the economy a little bit? Is that what's happening, more or less?
Well, that's the headline. I think the headline is, yes, you get 130% tax relief, but you've got to be, as I said, you've got to just be a bit careful, because the sting is in the tail with if you sell the assets. And also the corporation tax rates are changing as well from March 2023. And they're going up. So you need to balance off the fact that if you buy the expenditure now, you're getting an enhanced deduction on the cost, while the tax rates are lower at 19%. But in a couple of years' time, the tax rates go up to 25%. But then you lose the 130% uplift on the cost. So there's a bit of it's only people like me that sort of can see through exactly what's happening. It's not as clear cut and beneficial as it would seem. I'm certainly for the smaller businesses, because it would make sense to accelerate the capital allowances into before 31st March 2023, because the rates of corporation tax don't go up to 25%. They only go up to 25% for the bigger companies anyway. But there's a little bit of sort of stealth tax going on, I think. And why, your question was really, why is the government doing it? I mean, the government are doing it to accelerate, to move the economy on, but they're also, I think, if you actually look at these sort of projections on all the measures that they're putting in place, the idea is to actually raise, well, of course it is, the idea is obviously to raise tax revenue, even though there is a immediate corporation tax saving in the longer run, I think, because whoever you're buying the equipment off, if you're buying the equipment off a UK supplier, then it becomes turnover for that business anyway, which they'll get corporation tax back on. So it's only, and then there's potentially a VAT implication and all sorts. So the ultimate aim is to raise revenue, even though it seems to be almost a tax giveaway. As I said in the presentation, I think the various factions of the government will eventually be coming into conflict, because on the one hand they want to spend a lot of money, but on the other hand they want to balance the books, and you can't do both unless you're prepared to raise tax, which might well happen as well. So that's where we are. Yeah.
So this is a very gentle way of them doing it, by the sounds of it.
I think this is probably, as I said, I think it's almost this has appeared to you as a giveaway, and for some businesses it will be, but somewhere down the line there will be something that gets taxed back, and we already know about some of it. The corporation tax rates are going up in a couple of years' time. Capital gains taxes potentially, but we can speculate. We don't actually know what's going to happen, but.
So even if the benefits aren't quite as great as the headline figures indicate, there's still benefits to be had. But talk to people who know what they're talking about and know what they're doing to make sure that.
Yes,
I would.
Absolutely. That's the key message. Yeah, absolutely. Yeah.
Excellent. Very good.
130%. was going to say 100%, but it's 130%. I agree with you.
Right, excellent. So I just wanted to check if there were any other queries for anybody or any other questions, because if there aren't, I think that will leave it there. But it's been a very informative session, Duncan. Thank you very much.
That's a pleasure.
I mean, of course, you know, as we normally do, we'll share Duncan's slides with everybody afterwards. We'll also send a recording of this webinar to everybody afterwards as well. So and as well as Duncan's contact details. So there is plenty of opportunity to follow up with Duncan if you have any specific questions, and I appreciate that you might not necessarily want to do that in an open forum as well. So you will be sent all of this shortly. So we'll wrap it up there. What I would normally like to do, as regular visitors know, is I'm launching a little feedback poll for people to complete. It's really for us to get a view of obviously what you thought of it today, but also tell us about, you know, what you would like to see covered in future webinars, because obviously we'll keep this going, and we want to make sure that we bring stuff to you that is relevant. So while all of that is going on, and people in the room are doing that, I'd just like to thank the viewers on YouTube for watching. Please like, share, and subscribe. I would also say that, you know, if you find these sessions useful, and if you want to learn more about the STC, obviously, you know, go to our website. Very much consider joining as well. These webinars are only the tip of the iceberg of what we do. We, you know, with our partnership with Be the Business, we offer mentoring programs, we offer advisory boards, we also open up new opportunities for people. Membership carries a huge amount of benefits as well, and we, you know, we work a lot to bring people together and, you know, create opportunities and allow people to collaborate. So if that sounds like something that you're interested in, please get in touch with us. And, you know, obviously the more members we have, we're a not-for-profit organization, so the more members we have, the more good we can do. So please do consider joining if you like what we're doing. But in the meantime, thank you very much for watching, and please like, share, and subscribe. Something to do with algorithms. So yeah, please do that. Thank you.